Hi, good afternoon, everybody, and thank you for the time today. This is Phil Resch, and I'm here to talk about uh, a couple things. So, estate planning is the title, but really what we're looking at is, mastering how to work with large cases, what the process is, how to find the right partners to do that. Because to be honest, there is a lot that goes into the whole process, and that's where I highly recommend not doing it alone. So, when you think about Valor Financial specialists here, what I always like to say is it's your vision, but our expertise. So, you have the clientele, you have the wherewithal to introduce us as your strategic partners for things like income protection. We're going to focus on estate planning today, tax-free retirement strategies, and more. As we move along, the list is getting bigger and bigger on the opportunities that you have here with Valor Financial Specialists. But today, what we're going to focus on is who really needs estate planning. And we're going to look at some current tax law and how to digest that when we talk to our customers, and then ultimately strategies to protect an estate. So, when you think about actual estate planning, we always say, who really needs true estate planning? And the answer really is everyone. So, whether you talk the small stuff like a basic estate planning, wills, living trust, naming of guardians, that stuff is so important because you don't want to leave anything to chance. I believe the statistics were 2 out of 3 people do not even have a will or living trust in place. Um, for us, when we got our will and living trust, the first thing that scared me was, oh, I'm signing this. That means I'm probably going to die next week. And it's not the case at all. It's just preparation. And as our job is financial professionals, we're always looking to look ahead at what people may not see currently in front of them. Naming a guardians is so important too, and you can mix it up as well. For example's sake, us personally, we have my sister and brother-in-law as the guardians in case something happens to myself and my wife. But my father's a financial planner, so he would get the cash to basically dole out what's needed to help raise my children. So you can mix it up as well. It doesn't have to be all for one person to take care of. So there's a lot that you can do with that. But really, what we're going to talk about today, again, mastering large cases, we're going to look at some of the advanced estate planning situations. And believe it or not, there are more people who fall into this category today and in the very near future than you can even understand. And so, when we look at current tax law, what I like to do is give a foundation. The basic foundation, first and foremost, is what is the current tax law? What is a lifetime gift exemption? When you think of a lifetime gift exemption, or what I like to deem it as, is a death coupon. So don't mistake that for actual terminology. But when you talk to people and when you try and relate to them to something easier for them to understand, I use the wording death coupon because it truly is what you use at the time of settling up your estate to see what you owe the government. So in 2022, the lifetime gift exemption per person was 12.06 million. Now, inside any type of estate planning, there's what's called an unlimited marital gift. So if the husband who typically passes away first were to pass away, his assets would then go to his spouse, where there would be no taxation. And so when I do the little slash there, 24.12 million a couple, that would be once again at the estimation or time of death when you would take the total amount of taxes, use that death coupon to take off part of the line item for estate taxing. Now that increased this year to 12.92 million a person, almost 13 million. Next year it will increase up to 13.61 per person, or just double it for 2 people. But it is increasing for the next couple years until we really hit that concern where we're looking at in 2025 when the current ruling in place is the Trump tax rules. And as we all know, currently Team Blue is in the office where they're trying to find ways to tackle a 33, 34 trillion dollar debt and not impact their value proposition, which is always taking care of the middle class and lower income families. And so, how do you do that? You look at things like reducing the death coupon or the lifetime gift exemption to anywhere between 3 to 6 million. I've now heard 7 million as well per person, or 6 to 12 million as a couple, maybe 14 million. So it's a dramatic drop from where we are currently to where we're going to be. And that's the problem that you're going to find when you look at, say, current federal estate taxes at 40% above lifetime gift exemptions. So if someone has, for example, say a $50 million estate, and what we're going to do is, let's say they both pass away in 2023. Well, you have a death coupon of 25.84 million that will go to the government, and then you're only going to pay taxes on the 24 million. At 40% is 9.7 million in taxes. Now let's just fast forward 2 years. We're now looking at 2026. Nothing has happened, nothing has changed. It reverts the rules back to, I believe it's 2009. And now all of a sudden you get 12 million per couple. You did absolutely nothing, but you've increased your taxes by over $5 million just by doing nothing. And so when you think about this, you think about the type of clientele that you partner with, they have 9 months to pay this off. So, do you have consumers in the real estate market? Are they real estate rich and maybe cash poor, or they say they're cash poor? Would they rather have 10 hotels today and then sell two or three off at a discount to pay off in 9 months their total tax bill? Or maybe do they sell a hotel today? They have nine that'll stay intact. So you have to think about all these questions, and it's thought provoking. It doesn't mean you have to answer it. But as we all know, consumers don't like to be sold, they like to buy. And if you try and force them to do something, they're going to push away. But if you offer thought engaging questions, that will help in the whole process, because really what we do is we try and uncover a problem that someone has that they didn't realize they have. And so I put here rumors and hearsay for a reason. There are a couple things that are on the docket with the government right now to actually help once again mitigate that 34 trillion dollar debt, but not impact the lower or middle income classes. So when you think about property, seeing though we're on the subject of property, there's a step up in basis. So if myself and my wife, we have a house, we bought it at $300,000. It appreciates to $1 million. Both pass away. We give it to our sons. Well, that in current times would be a step up in basis, meaning that that $700,000 in gains would be eliminated, and my kids would get $1 million property. So they wouldn't have to pay taxes on any gains. Well, some people have tried to move these assets into irrevocable trusts. And when you do that, the government just this year has actually officially stated that you will eliminate your step up in basis by doing that. So that $700,000 gain is now taxable if you try and move it out of the eyes of the government. And they're talking about doing this for normal out of trust designs as well. And they're also talking about doing that with stocks. So say someone bought an Apple stock in the 80s, your first $1 trillion company. Well, then at that point, you inherit this stock. Now you have to pay taxes on it. So that's some stuff they're thinking about. The other stuff would be increasing that federal estate tax. So if you'll notice, I put the federal estate tax at 40% because that's what it's currently at. Well, they're talking about increasing it to 50. I've even seen articles go all the way up to 77%. So anything above your death coupon or what you have for protection standpoint could get taxed up to 77%. Now that's at the federal level. Let's not also forget that certain states have their own state and inheritance taxes. So really it's the Northeast, Northwest, and the upper middle of the country around the Great Lakes. You'll see that there are state estate taxes, inheritance taxes. So for example's sake, if you live in my old state of Connecticut, you have a state tax of 10.8% to 12% on estates above 7 million. Now, Connecticut is one of the richest states per capita, followed by New Jersey, where they go back and forth. So as you can see, there's a lucrative opportunity there for the government to get some extra money on some of the more profitable states. Then you also see inheritance taxes. I'd say the worst place to die is Maryland, because you'll have federal, state, and inheritance taxes. Now, if, for example, say, because I live in Tennessee, say my parents lived in Pennsylvania. So if my parents passed away in Pennsylvania and I inherit all those assets, even though I live in Tennessee, I'm going to have to pay the inheritance taxes because the assets are in Pennsylvania. Vice versa, I live in Pennsylvania, my parents live in Tennessee, I wouldn't have to pay any inheritance tax because the assets were in Tennessee. So if you have clients who have assets in different states, they should also understand that that could impact from the inheritance perspective as well. So all of that plays into a factor when doing proper estate planning. And so when we look at estate planning, we talk about trust designs. So we're going to specifically focus on the irrevocable trust today. Irrevocable trusts have the ability to block from federal estate taxes. It also protects you against probate. So you don't have to put all your assets through the system where everyone can see them. Now, who always likes to see what assets you have left over? Creditors. What if there are debts that are left over? Or more importantly, what if the next generation who's getting all this money, getting all these assets, have creditors? That's a concern. You can't touch assets that are inside the trust, but if it's in that person's name, then some creditor could go after it. So we call it creditor proof. And there's the ability with irrevocable trust to control your hard-earned assets beyond the grave. So you worked hard to earn it. Why not retain it even in the afterlife? So we talk about how can we utilize this lifetime gift exemption today while alive before it drops, because you can actually exchange this death coupon in early and take advantage of what's available today, as opposed to letting Uncle Sam dictate what you do. So we're going to talk about repositioning assets into a trust and how we can have that conversation. So for me to do that, what I'm going to do is I'm going to utilize this little whiteboard action here. And I'm going to take my head off the screen because you don't want to see my head bending over. But panelists, if you could just let me know, do you see the white screen where I'm about to put $30 million? Fabulous. Okay. So let's say, for example's sake, I have a net worth of $30 million, or my client has a net worth of $30 million. Great job. Congrats. Say they're in their mid 40s. Mr. and Mrs. Client, if I were to tell you today, do you think you could live off of $20 million? Do you think you could do it? Now, most people in this scenario are very hesitant to respond because really what they're saying is, all right, Phil, what are you doing with my $10 million? And that's always a fun question, right? But if we think about what we're going to do, it's still going to stay in their pocket, just in a different pocket. We're going to reposition the asset into an irrevocable trust. Now, in an irrevocable trust, let's say, for example's sake, My customer is a husband and a wife. Husband grants the money over. He is a grantor spouse, and the wife is a non-grantor spouse. And that's important for when we talk about how you can control the money while alive and after death. Because most people are concerned about two things: taxes and control. And so when we think about putting $10 million into an irrevocable trust, what do we immediately lose? We immediately lose control, right? That's what we think. But I'll show you how you can retain control. The other thing is taxes. So if you put an excess of $13,000 inside of an irrevocable trust, you are now taxed at the top tax bracket, which is currently resting around 40%. Well, I could argue and say that if you have 30 million on this side or 20 million and 10 over here, you're at the top marginal tax bracket anyway. So in my opinion, taxes are really a moot point. So we'll get back to control in a second. Now you can utilize this $10 million inside of this trust. We're using this death coupon in advance, so we don't have to, we don't get it at death per se, but how can we take advantage of it today? Once again, clients are in their mid 40s. They've done very well for themselves. How can we take advantage of this? Well, Phil, I say we can put this into a stock and bond portfolio where the money can go up, it can appreciate and grow over time. And I would say mid 40s all the way up to about age 80, 85, you're going to see this asset increase to about 60 million. Now, why do I say 60 million? Because once again, you have ups, but you also have downs. Ups, downs. So the worst thing you could have is your asset crash, and then all of a sudden the client passes away. So when we think about estate planning, the true idea of estate planning is we want to find something a little bit more conservative, a little bit more advantageous for the client to not fear that you'll have those type of drops that we can see in the market. So what's another investable asset? We put $10 million into municipal bonds. Now, municipal bonds are great. Why? Because they grow tax-free. You don't have to worry about taxation. But the downside is they don't grow as well as your stock and bond portfolio. So now you're looking somewhere around the realm of $40 million versus 60 that you have up here. Because of the fact you're looking for a more conservative growth product so you can mitigate taxes and not have to worry about downside risk. Well, if I could give you the best of both worlds by leveraging a beautiful asset that we like to call life insurance, where we put $1 million in a year for 10 years. We start out at, say, 40 million, but it increases all the way up to 100 million by the time the client passes, all tax-free. Any cash value that grows inside of the policy is not taxed either. So when we think of the asset class that you would put inside an irrevocable trust, the one that makes the most sense is life insurance, which then creates an ILIT. So us in the insurance industry, we love acronyms. ILIT stands for Irrevocable Life Insurance Trust. So all it really is the asset class of life insurance inside of an irrevocable trust. That's the easiest way to put it. Now, let's go back to the fears and the concerns of control. Everyone always says, oh, I don't want to lose control of my money. Well, it's a fair point. Well, in this scenario, we had a husband put his money into the irrevocable trust. So he is the grantor. Now, through special provisions called HEMS, which stands for Health, Education, Maintenance, and Support, the non-grantor spouse, say the wife, is able to pull funds from this policy and pull it out and utilize it for what she needs it for. So say, for example's sake, she gets a Porsche every single year. I mean, these people are loaded, so that's not out of the question. That is considered maintenance or support. So through the provision of HEMS, your consumers or your clients have retained the asset even after death, or even while alive, they still have control of this $10 million in the growth pattern that you're going to see in it. But then after death, we talk about controlling your money then. No one wants a silver spoon. They want to make sure that their clients, kids, I should say, are still working hard for their money. So you can add provisions to these type of trusts. For example, say a W-2 provision. What if I, Phil Resch, didn't want my kids just living off of this money? I want them to work for it. So they have to go to my trustee every single year and show them a W-2 or K-1 or whatever. And then at that point, the government, the trustee will match it. So it's a way for them to work harder. So if my kid comes up with 100K W-2, then all of a sudden the trustee will then match it and give them 100K out of the trust account. That's how people stay affluent. That's what you call generational wealth. That's what the Kennedys, the Rockefellers have been doing for generation after generation after generation. Now, to kind of share with you a sample of an illustration so you could see exactly what I'm talking about, let me know, panelists, thumbs up if you can see the screen, or yes.
Yes, we can see the screen.
Thank you, kind sir. Nice to hear your voice.
You're welcome.
All right, so in this scenario, we have a 46-year-old male, and they're going to put in $1 million for 10 years. Now, everyone in that scenario is going to say, man, that's way too expensive. I get it. It's a huge price tag. But what you're doing is you're leveraging the current rules that you won't have potentially in a couple years. So you see, for 10 years, you're putting in $1 million a year. Now, if we look at the illustration rate of 5.74%, first year, second year doesn't look that great, of course. But as you continue moving on after these 10 years, you've pretty much gone back to net neutral. 10 million invested, 9.6. So by year 11, you should have all your money back and then some with a 5.74 rate of return. But look at what you're getting. So if gentleman passes away within the next 10 years, you have 50 million to 53 million. And the numbers go up. We look at age 85, 86, average mortality age is probably around 80. But if we look here, we've invested 10 million. We have 4.7, almost $4.8 million in cash and $91.5 million in death benefit with a 5.74% rate of return. So when you look long term, not short term, too many people are looking at the initial price point and forgetting the actual value of what they're buying. This is what they're getting in the long run. Life insurance sales are always long run solutions. They're not short term, immediate solutions. And as you can see here, we have a great story to tell. Now, this is just an example of one carrier, one product. Keep in mind, once again, we're in the independent world. We can do whole life. So if a client has a whole life guy banging down their door, we've got whole life as well. It's not going to give you as much, but if they really, really want guarantees, we got that too. So that's the beauty of what we have here. This is an IUL, of course. This is a single life. There are strategic ways that you can do single life, you can do joint life. It just really depends on your clientele, what they're looking to accomplish, and there's pros and cons for both. So a lot of you are like, well, my clients really aren't at that level, but I always start out with that level because you never know. You might come across someone that says, hey, I got an estate planning specialist you should really get some education from, and set up some time and we can partner together. But what if you don't have a client that's that high net worth? Are there additional strategies? Well, there are. So when we talk about current tax law and what's going on in the industry, I myself can put $17,000 and not impact my death coupon, that lifetime gift exemption, into an irrevocable trust and not have to worry about messing with bigger figures. Now, my wife can do it too. So we'll say 34,000 this year for a married couple. I actually think it's 18,000, but anyway, let's not let the facts get in the way of a good story. Married couple, 2 kids, 17,000 per kid per parent. We can each put in, or we can put in a total of $64,000 into an irrevocable trust and use what's called Crummy rules. It's CRUMMEY or CRUMMY. That's the last name of a lawyer who created these rules. But the idea is to allow people to gift without impacting their lifetime gift exemption and still provide a valuable solution for those who might not be the 30, 40, $50 million people, but they might be $1, $2, $3 million people who are still looking for an opportunity to provide a value to their children or grandchildren. So how do you do this? It's a preservation of estate by estimating your total net worth. We would help you partner with an estate attorney. Never go alone. So we as insurance professionals should always be there for our clients when it comes to drafting up the estate documents. I've read irrevocable life insurance trust documents. They're anywhere from 30 pages to 60 pages, but a good nighttime read. But most importantly, you got to partner with a representative that can find the right carrier for you. So that's what we're here for. Once again, 30 plus carriers at our fingertips, we have a great story. So here's an example of a second to die. So you have a husband and a wife, mid 50s, both preferred, and they're putting in that lifetime, not lifetime, their annual gift exclusion amount of $64,000. So once again, you look at year 10 from those who think from the investment standpoint, the investment, not all that great with what they think, but you're net neutral or close to net neutral by the end of year 10, but you're able to secure for your 2 kids $8.5 million in death benefit. Or as time goes on, you'll see the cash accumulation still grows. So after 30 years, you've invested 1.9 million and you're up to about 3.6, almost $3.7 million in cash value in case you need it. So once again, you can use those rules to pull money out if you truly, truly need it. So what do we think about here is the process. What's the process with the carrier? So once again, we want to start the underwriting very basic is we have to evaluate the estate. Now, this is typically done with the client, the agent. If you need an expert, I'd gladly help with that too. We can partner together. The financial advisor, a lot of these higher net worth people have financial advisors. So typically I would say meet with the client first. And then they say, well, we have so-and-so and so-and-so. I would say, well, the whole objective is to protect and help you, Mr. and Mrs. Client. So let's have a meeting with everybody together. You, me, your financial advisor, CPA, or accountant, and we'll hash this out. Now, what we can do is submit the business to the carrier with the owner as trust to be determined because we want to get the formal approval. Now, depending on the size of the case, if it's a 20, 30, $40 million case, once again, we have the ability to shop all 30 carriers without even submitting an application first. We can gather all the information in advance, including their third-party financials, typically signed by a CPA, to evaluate their total estate. And then we can go to the carriers, the 30 carriers, and have them fight for your client's business. Once we get the approval, then we go back to the estate attorney. The estate attorney then finishes up the trust design. We rewrite the application, just the first part with the ownership as the trust, whatever the trust name is. And then the owner would sign as the trustee. and it would be their name plus TTEE indicating trustee on the back end. Now, the thing that I will mention in this scenario is a lot of people will do, if it's a husband, they want their wife to be the trustee. The problem with that is it ties the trust back into the people's estate. So you don't want to do that. It would be a relative, friend, your brother, sister, whoever, but it shouldn't be your spouse. Okay. The kids would be the beneficiaries of the trust. You'd have an independent third party. You could even use a trust company. You can use the lawyer's office, whoever you may need from that standpoint. But we don't want anything to tie back to the trust. And then you include the trust certification form, which basically lines out all that information about the trust. And then we place the business. And that's the typical process. So larger cases can take north of a year. Like I've worked on a case that took about a year and a half ish, but the gross is worth the grief. I'll put it that way. There's a lot of competition with these. So that's why I say don't go at it alone. And you really aren't alone. Us in the industry who've been in this industry for a long period of time understand things that are widely used, just not really talked about in a lot of different areas. This is called the MDRT split. MDRT stands for Million Dollar Roundtable. It's for the top of the people who produce hundreds of thousands of dollars in life insurance. So, pending on the amount of participation one person would have, you would agree upon the conversation in advance on doing a split. As one of my mentors always said, part of something is better than all or nothing. And that's where, when you work as a team, you can accomplish better goals than by doing it by yourself. And so, when we think about the true estate planning, the idea of not planning is actually a plan. It's really failing to plan. So, you're going to plan to fail. That's why I say the time is now for us to really enact on this. You've got 2 years to really work for those larger cases using the lifetime gift exemptions before there's an extreme drop. Why do we start now? I already said it takes probably about a year. And two, you have to think about also the fact that these estate attorneys are going to get all plugged up by the end of 2025 when the rules change. So you have to work now on this. And for those of you, who want to see what's coming soon, I want you guys to mark your calendars today for the first Valor Convention on May 11th. It's going to take place in Dallas, Texas. There's a lot more detail coming, but keep in mind the ideas about collaboration. We go back to that idea of the MDRT split. I can work with anybody in any different organization, and we can partner together and still win together. That's how these things work. So think about the idea of collaboration, what we're going to entail in May that will be great ways for you to make money. And that's what this is all about. Help people feel rewarded. And, it's one of the greatest jobs in the free enterprise world. So when we think about this, estate planning is a huge market to tackle. You don't want to tackle it alone. But I do want to say thank you guys for the opportunity to talk about this today. And we'll open it up for any questions.